Now, with that in mind, this started off as just an outline of what I'm covering, which is three main areas: income tax, capital gains tax, and inheritance tax. And I started to colour code what budget announcement it came out of, and also when these measures are coming into effect. And what we've got there is a bit of a confusing slide, to be honest. But we've got a 5-year period of some of these measures coming in. They're being phased in, perhaps over a 4-year period. And we are going to cover off all of those this morning. So the first section is income tax, and we do have a brand new dividend regime that came in 6th of April this year, so I'm going to spend a bit of time on that because that's going to impact on quite a few of you. We've got the new personal savings allowance. We're going to have a bit of a recap of income tax rates, and finally a look at some of the changes to property taxation that have come out of the recent budgets. And finally, a very quick look at digital tax accounts, which has been heralded in the press as the end of the tax return. So, the new dividend regime that came in 6th of April this year, and it really is a major overhaul of how dividends are taxed. It's going to affect dividends that you receive from private companies. Any of you with investments in general investment accounts, you likely get dividends on those investments. This is going to impact on you as well. Only ISAs remain tax-free. They're not impacted by the new regime at all. So the dividend tax credit, which we might be familiar with, has been abolished. So it used to be if you received a £90 dividend, you had a £10, 10% notional tax credit attaching, so your gross dividend was £100. That's what went on your tax return, that was your taxable income. That's now gone. If you have a £90 dividend, £90 is what goes on your tax return. We've also got a new £5,000 dividend allowance, and I'm going to look at some examples of how this is going to impact on people, because I think that's the best way to show it. But actually there is a question of whether this is a true allowance. It's more of a nil rate band almost, where the first £5,000 of dividends are being taxed at 0%. And on top of that, we've had an increase in the rate of taxation on dividends across the board. So in terms of the dividend tax rates, what we've had is an increase of 7.5% for everybody. That's whether you're basic rate, higher rate, or an additional rate taxpayer. When I'm saying an increase of 7.5%, I'm talking about the effective rate of tax up here. So, as I said before, you used to have a notional tax credit attaching. The effective rate of tax would have been on that £90 you'd actually received. So, as a higher rate taxpayer, 25% of that dividend you actually received in your hand would have gone in higher rate tax. That's now increased to 32.5%. We've got a 7.5% tax rate for a basic rate taxpayer, and that's one of the biggest changes for basic rate taxpayers. They no longer can just assume that their dividends have been taxed at source. They are going to have to look at that position. So like I said, looking at some examples is probably the best way to see how this is going to impact. So here we have Paul. He has a salary of £20,000 and dividends of £9,000. And all I've done here really is just follow through to get down to this bottom figure under the new rules here and the old rules here. And what he's got is a £200, just over £200 increase to his tax liability. Oh, sorry, wrong way. So he is worse off under the new dividend regime. If we have a look at John, he's got exactly the same level of dividend income, but he's got double the salary. So £40,000 of salary. And again, if we follow through down to the bottom line of what the tax due is, he is nearly £500 better off under the new dividend regime. So it seems to be a bit of a mismatch there between the government's stated intention of lower earning individuals paying less tax, because we can see under this new dividend regime we've got somebody with double the salary of somebody else who's better off with the new dividend regime, whereas the other person is worse off. I do apologise for this slide slightly. What I'm trying to illustrate here is the fact that the dividend allowance, as it's being called, is not a true allowance in the sense of the word. So on this side of the screen, if it were a true allowance, and just by the way, these numbers have been used, I'm using the figure from the example with John, so the £40,000 salary and the £9,000 dividend. Down the bottom, you've got your personal allowance. The dividend allowance, you would then think would come off and exempt the next £5,000 of income. And up here, what I'm trying to show here is the £4,000 of dividend income that's remaining taxable. So that's the £9,000 less the £5,000 dividend allowance. And if this were a true allowance, you'd see £1,000 of those dividends being pushed up into the higher rates. However, that's not how it works. When it first was announced, these measures, that's actually how a lot of people in the industry did think it was going to work, i.e. as a true allowance, and examples were published which then had to be retracted. So what happens instead is you have your personal allowance at the bottom, we've then got John's salary coming in here, and then this whole section represents the £9,000 of dividend income. So that £5,000 dividend allowance there, although you're paying no tax in that section of income, it does use up the rest of the basic rate band, and therefore we've got the entire £4,000 of dividends going into the higher rate tax thresholds. This is going to impact on people because it's not a true allowance. That means that you still have a higher taxable income for things such as whether you're reaching the level at which your personal allowance is withdrawn, if you've got a high income child benefit charge, what level of new personal savings allowance you're entitled to. So I think we just have to be a bit careful when we're talking about allowances because it isn't actually a true allowance in the sense of the word. At the top here, I've summarised where you are under the new dividend regime, whether you're going to be better off or worse off under the new rules. So if you have less than £5,000 a year of dividend income, you're either going to be better off or no worse off. As we saw earlier, there is then a disparity between whether you're a basic rate taxpayer or a higher rate taxpayer. And the break-even point for a basic rate taxpayer is £5,000 of dividend income. Once you get above £5,000 of dividend income, you are going to be paying more tax. For a higher rate taxpayer, it's actually £21,667 before you are paying more tax. One point to note is HMRC have already adjusted people's PAYE codes for the anticipated additional tax due under the new dividend regime. Just bear in mind you don't have to accept that coding, you can still put it through your tax return as normal. And effectively what that means is you've got longer to pay the tax. It's just HMRC trying to get the tax a bit earlier than you would otherwise be paying it. That was a quick gallop through dividend taxation, but I've got a few bits to get through this morning. So the personal savings allowance, this is another new allowance with commas either side. Again from 6th of April this year. And the level of personal savings allowance you're entitled to will again depend on whether you're a basic rate or higher rate taxpayer. With additional rate taxpayers, that's with people of income of over £150,000 getting no allowance at all. So you're going to have either £1,000 or £500 of interest that can be received tax-free now, effectively. Tax is no longer deducted at source, so you may have been used to your bank interest being paid with a 20% deduction at source. That's gone from 6th of April. All interest is being paid gross. And like with the dividends, you might have to just assess your tax position because where before you could assume that the basic rate tax had been deducted at source, you might not have an additional tax liability. You may now need to consider whether or not you do need to do a tax return, whether you do have tax to pay. Now, at the bottom I've put how to calculate whether you're a basic rate or higher rate taxpayer isn't as straightforward as it seems. And I've got another little example with Anne. So she has a salary of £41,100, interest of £9,000 and dividends of £4,000. And basically if we work through here, so she's got £35,000 of taxable income after her personal allowance. So her salary is taxed entirely at 20% basic rate of tax. The dividends are within the £5,000 dividend allowance, so there's no tax on that. So you would think, well, she's a basic rate taxpayer, she's only paying tax at the basic rate. But actually, because that income within the dividend allowance counts, she's a higher rate taxpayer, because if she were paying tax on that dividend income, she would be up into the higher rates. So therefore, instead of getting the £1,000 savings allowance, she gets the £500, and so she has to calculate the tax due, although at basic rate, on the basis that she's only getting the allowance for a higher rate taxpayer. So you can imagine some lovely conversations trying to explain this to clients that you're only paying tax at the basic rate, but you're a higher rate taxpayer and therefore you're only getting the reduced allowance. I just wanted to have a quick summary of, we've had 2 new allowances coming out of the most recent budget that are with us now, so the dividend allowance and the personal savings allowance. And as I've said, neither of those are true allowances in the way that the personal allowance is. And proposed for next year, we've got 2 new allowances that were due to come in. Whether or not they will, we'll have to wait and see. But that was a property allowance of £1,000 and a trading allowance of £1,000. And these were viewed as taking people who maybe had a small bit of rental income below that threshold, or a small bit of self-employment or trading income, so that they wouldn't be paying tax on that anymore. As I said earlier, we've had the removal of the tax credit at source for interest and dividend income, and potentially therefore more people needing to complete tax returns, and calculating what your position is only getting more and more difficult with all these little allowances and the interaction between them. This is just really summarising where we are for the current year, which is highlighted in red there, in terms of personal allowances, rates of tax, the dividend allowance and the savings allowance we've covered off. The 2 main points I just wanted to bring out of this slide really is, if you have the right sort of income, we can actually get £22,000 tax-free in a year. And what I mean by the right sorts of income is basically if we've got some pension or salary which is using up our personal allowance, and then maybe some savings income. Because if you start adding together the personal allowance, the new dividend allowance, the personal savings allowance, and not forgetting that we also have a £5,000 starting rate allowance for interest, that all comes to £22,000. So potentially, if you've got the right sort of income, you've got up to £22,000 of tax-free income in any year. Well, not in any year, for this year. And the other point I just wanted to draw out at the bottom here is we still have this situation where if your taxable income, so bearing in mind those allowances, income within those still count towards your taxable income, if you're reaching that £100,000 limit, your personal allowance is being withdrawn. And because as the personal allowance goes up, the way that the personal allowance is withdrawn is £1 for every £2 over that threshold. So too is this range of income getting bigger, where you've got an effective 60% rate of tax on that portion of income as the personal allowance is withdrawn. So if you are at this threshold, it is really worth looking at perhaps making pension contributions, qualifying gift aid donations, because it becomes really efficient to do so, because once you're at £101,000, that £1,000 going into a pension is going to get 60% relief from tax on it. So moving on to rental properties, there's been quite a few changes coming in around here. So from 6th of April 16, a few changes. If you had a furnished property, you used to be able to claim a 10% wear and tear allowance based on the level of gross rents. That has been abolished as of 6th of April this year. So even if you have a furnished property, you can't claim this wear and tear allowance, and you can only claim, for example, when you renew the furniture or the carpets or the curtains within the property. The rent room relief, which is where you let a room in your main house, that limit has increased, which basically gives you tax-free income of up to £7,500 a year, which equates to a lodger paying £625 a month. But bear in mind that exemption is only if it's in your home. The biggest change is coming in, well, proposed to come in from April next year, and I can't see this being something that's going to go away, is the withdrawal of mortgage interest relief for higher rate and additional rate taxpayers. Traditionally, mortgage interest and other finance costs, they formed part of your cost in your rental account. So you'd have your income, that would be one of the allowable costs, and you'd come down to your taxable profit at the bottom. There are rules around how much mortgage interest you can claim for, but I'm not going to go into those today. It's to do with the capital value of the property. Instead, what we're going to have is a basic rate tax reducer, and this is one of those proposals that's being phased in over the next 4 years. So by the time we get to April 2020, we're going to have this in its entirety. Again, the best way sometimes with all of these sort of numbers and figures is to look at an example so we can see how that it actually might affect you. So 16-17, so this is under the current regime before any of the changes come in. If we've got a situation with rental income of 20,000, mortgage interest of 8, we've got a rental profit of 12,000. Work out your tax at 40% on that as a high rate taxpayer to give you a tax liability at the bottom. 2020, this is where the new measures have come in completely. Instead, we've now got a rental income of 20,000 and a rental profit of 20,000. So again, your taxable income is 20,000 now rather than 12,000. So again, this might impact you in terms of your personal allowance withdrawal if you're getting up towards the higher levels of income. And what you do is you calculate the tax in full on that rental profit, so 8,000, and instead you get a tax reducer here for 20% of the mortgage interest. So 20% of the 8,000 comes off. But in the next 4 years, you've got a 25% increase in tax, at least, because that's assuming that you aren't then getting up to the higher levels of income where perhaps you're losing the benefit of your personal allowance. If you do have rental properties, you do need to look at this and work out how it might be impacting on you. As I said, in a relatively short period of time, that's quite a big increase in your tax. On the subject of properties, slightly not an income tax subject, but stamp duty land tax, we've had some changes again coming out from the 1st of April this year. And again, it's not great news for those of you with second properties or buy-to-lets. There is a new 3% supplementary charge. So on top of the rate you would have already paid in stamp duty land tax, if you are buying a property which is not your main home, so a second home, holiday home, rental properties, you will be paying more stamp duty as of the 1st of April 2016. There are arrangements for where there's an overlap in ownership. For example, you might have bought a new home but not yet sold your old one. But the way the legislation is currently drafted, which you might note at the top, I've said it's been enacted, but the legislation still isn't actually final, is that you would have to pay the tax charge up front and then claim a refund. So that could have a massive impact on you in terms of cash flow implications. And just as an example there, if you were buying a property for £275,000, that's an extra $8,250 in stamp duty land tax over where you would have been pre-1st of April. We had another change come in. This time it was a slightly positive change. You may recall last year, for residential properties, we moved away from having the cliff edge with the stamp duty land tax, i.e. you never bought a house at $250,000 because you would have been paying the high rate of stamp duty on it in full. And we moved now to an incremental charge, and they've now made that the same for commercial properties. So again, you don't have that cliff edge system there. In your packs, you have got some examples. I don't have time to go through them this morning. I'm happy to talk to anyone afterwards. But it just covers some examples where perhaps how this new supplementary charge on the stamp duty land tax may impact you if you're moving house, buying a second property, helping children to buy their properties and so on. But do have a look at those if it's of interest. We did have some changes coming out of the most recent budget around pensions and savings, but Adrian is going to be covering those off in his presentation this morning, so I'm not actually going to touch on those. The final bit that I just wanted to comment on before we move on to capital gains tax is the digital tax account. Now, I'm going to read what HMRC published on this, which was, by 2020, HMRC will have moved to a fully digital tax system where bureaucratic form filling is eradicated. Taxpayers should never have to tell HMRC information it already knows. Unnecessary time delays are eliminated, the tax system operates much more closely to real time, and taxpayers have access to digital accounts, bringing an end to the tax return. Well, the consultation results were due out in May, and that was delayed until after the results from the EU referendum, which we now have, and I don't think we're going to hear much on this for the time being. They were already behind schedule in delivering this to taxpayers. They had said by the end of 2016 every taxpayer would have their own digital account. They were moving towards quarterly reporting for businesses, and I think some of the concerns perhaps there were that might lead to a quarterly payment of tax. And I think, looking at it from my perspective, I don't really see how having a digital tax account will bring an end to the tax return, because as we've seen, the layers of complexity around what your tax position is, what allowances you can have, how they all interact together, I think you're still going to need that interaction to know that what HMRC are calculating is actually the correct position. But anyway, as I said, whether or not anything will even come out of that following Brexit, we'll have to wait and see. Capital gains tax. Well, this was a really welcome announcement in the 16th of March budget. At the moment, it's still going ahead. It is possibly one of the areas that we might see some change in if we are having to plug a hole in the economy. CGT last year was notoriously not included in the triple tax law. And last year when we were here, we were saying, oh, possibly that one might be one to watch, it might go up. Instead, we had a reduction, which was welcome. And we're going to look at that. Again, some changes around the taxation of property. And finally, some more welcome changes to entrepreneurs' relief. So, up until the 6th of April, we had 3 rates of capital gains tax. 10% for qualifying entrepreneurs' relief gains, 18% if you're a basic rate taxpayer, and 28% as a higher rate taxpayer. In the budget, they announced that the basic rate and higher rate tax was going down to 10% and 20% respectively. So a reduction there, unless it's residential property. So the residential property, they remain at 18 or 28%, those rates there. Bear in mind, your main home is probably going to qualify for relief under principal private residence relief, so that won't impact in terms of your main home. But again, if you've got rental properties, if you've got second homes, then that higher rate of CGT is in force. So we've now got 5 different rates of capital gains tax to be considering. Another announcement coming out of the budget, which was not as welcome, is a proposed 30-day report and pay for capital gains tax, again on residential properties. So we're seeing a bit of a theme here. So if you sell a residential property, it's proposed that from April 2019, you would have to make a report and pay the tax due on that sale within 30 days. Currently, it goes on your self-assessment tax return, and the tax is due the 31st of January following the end of the tax year, giving you a 9 to 21 month window to pay that tax, depending on where in the tax year you sold the property. So that's a massive reduction down in the time you've got to pay, and therefore going to have cash flow implications as well. As I said, we're seeing a bit of a theme here around property ownership, and I thought just summarising at this point where we've got to in terms of second properties, rental properties. So income tax, we've got the withdrawal of the mortgage interest relief for higher rate and additional rate taxpayers. We've got the removal of the wear and tear allowance. We've got the 3% supplementary charge for stamp duty land tax. And we've now got the reduced rates of CGT not applying to residential property, and this new proposed 30-day report and pay. It is perhaps an area where we might see some further changes, some further restrictions to the tax reliefs available. I know that there's been some stuff in the press about potentially council tax rates going up again on second properties to perhaps 150% of the normal rate, but we'll just have to watch and see. This was another welcome announcement in the 2016 budget, and it was announced as being an extension to entrepreneurs' relief. So entrepreneurs' relief is where you have qualifying gains of up to £10 million. You can get this reduced 10% rate of CGT. What we've actually had introduced, well, proposed to be introduced, is a new and separate relief with its own £10 million allowance. So potentially you've got entrepreneurs' relief at £10 million, and then this new investment relief at a further £10 million allowance. And it's aimed towards investors in private companies, but where they weren't meeting the requirements to get entrepreneurs' relief. So for entrepreneurs' relief, the main requirements were you had to have a 5% shareholding minimum, you had to be an employee or a director, and your disposal of those shares had to be part of your withdrawal from the business. And those requirements have been removed from this new form of relief. In fact, it goes a step further. You cannot be an employee or connected to an employee. So it applies to unlisted trading companies. There's a 3-year minimum holding period, but it does mean that there is a potential reduced rate of CGT of 10% for up to £10 million worth of gains on those types of investments. The final topic I wanted to cover this morning is inheritance tax, and in particular the residential nil rate band. So The residential nil rate band, the Conservatives manifesto, they had talked about family homes coming outside of the scope of IHT. They talked about a £1 million nil rate band, and we've sort of got to £1 million. So the 325 is the standard nil rate band that everybody's entitled to. That's been frozen until the end of the current Parliament. And we've now got a staged introduction of this new residential nil rate band, which is worth up to £175,000 per individual. If you've got a married couple, times that all by 2, you're getting up to the million. So it's the 2 325s and the 2 175s. That's where we're getting this £1 million allowance from. But it comes with quite a few caveats. So first of all, don't die before the 6th of April 2017. And in fact, if you want to get the full relief of the full 175,000, you need to not die until after April 2020. It's going to be tapered away for estates worth more than £2 million. So don't die too early. Make sure your estate's not worth more than £2 million. But also, you have to have had a main residence at some point, and it has to be inherited by a direct lineal descendant. So they mean children, they mean grandchildren. It's not going to work if you leave it to brothers, sisters, nieces, nephews. You will not qualify for the additional nil rate band. There are downsizing provisions contained in the legislation for disposals taking place after the 8th of July. But the legislation at the moment is incredibly complex and convoluted, and professional bodies are still making representations to HMRC to try and get this whole topic made a bit less complicated. Simplified, that's the word. So all we're saying at the moment is keep records. If you are downsizing your main home, just keep records of what's happening. But you may want to revisit your wills, make sure that, have a look at your estate. Would you potentially qualify for this residential nil rate band? You do actually need to look at it. You can't just assume, we've got £1 million. Bear in mind as well, the £2 million threshold is before looking at business property relief. So people sometimes sort of discount their business property relief assets when they're looking at what their taxable estate is, but you can't do that. Sometimes there is some planning you can do around making lifetime gifts because they don't count towards the death estate. Looking at trying to get your estate to below that £2 million level, because straight away that's £140,000 tax saving, being the 40% on 350. That is everything that I was going to cover with you this morning. I do appreciate it's been a fairly quick run through quite a lot of topics, but there was limited time this morning. I am available afterwards, and so are a couple of other people from the team at CKLG if there's anything that you want to talk about that we haven't covered, or to go into any of the topics in more detail. But just a few points to take away from this morning is considering how the changes to dividend taxation may impact you, if there's any portfolio restructuring you can do. Look at if you've got property portfolios, again, how are these changes going to impact on you? Looking at your income tax position, is there any restructuring that can be done? Reviewing your estates, looking to see if there's any inheritance tax planning that you might want to consider. But also just bearing in mind that, as ever, the interaction and complexity with all of these taxes is only increasing, and take advice before making any decisions.